Four companies you have probably never heard of may control up to 90% of the food moving across the entire planet right now. The wheat, the corn, and the soybeans behind almost everything you ate this week. In 2022, the same year that pushed more than 300 million people into hunger, those same four companies posted the highest profits in their history. One of them made more money in 12 months than it had in most of the previous decade combined. No election put them there. No headline explains how they got that much control. Just four private boardrooms deciding, quietly, how much the world pays for bread. How does a handful of companies almost nobody can name end up holding that kind of power over something as basic as food? And what happens when the people who control the supply also control the price? That's the question this documentary is going to answer. Right now, an estimated 540 million metric tons of grain move through international trade every year, out of roughly 920 million tons traded globally, according to the United States Department of Agriculture. By some measures, four companies alone handle more than half of that, and depending on which estimate you trust, their real share climbs even higher. Research groups, including Oxfam, SOMO, and the United Nations Conference on Trade and Development, put the four companies' combined share of global grain trade at somewhere between 70 and 90%, depending on the commodity and the year. A separate study prepared for the European Parliament using a narrower methodology focused specifically on wheat, corn, and soybeans put the number closer to 50 to 60%. Nobody agrees on the exact figure, and this documentary won't pretend otherwise. What every serious estimate agrees on is the shape of the picture. A tiny handful of companies handling a share of global food trade that is wildly out of proportion to how many people have ever heard their names. Those four companies go by a kind of industry shorthand, the ABCD companies: Archer-Daniels-Midland, Bunge, Cargill, and Louis Dreyfus. The name sounds almost bureaucratic for what it represents. The four essential gatekeepers standing between nearly every farm on Earth and nearly every kitchen, a position built one silo, one rail line, and one port terminal at a time. Ownership only sharpens the picture. Archer-Daniels-Midland and Bunge are publicly traded on the New York Stock Exchange, technically owned by shareholders around the world. Cargill is different. It's the largest privately held company in the United States, and roughly 88% of it still belongs to descendants of the Cargill and Macmillan families, around 25 people spread across generations. Louis Dreyfus tells a similar story. It remains controlled by descendants of the family that founded it in 1851. Two of the four gatekeepers of global food are, in essence, still family businesses. Just family businesses with the infrastructure of a small nation and a balance sheet most countries would envy. None of these four companies built that kind of position overnight. It took more than a century, and it started in four very different corners of the world, long before anyone imagined a global food system at all. Bunge began in 1818 in Amsterdam as a modest trading house. Louis Dreyfus started in 1851 when a young grain merchant named Leopold Dreyfus began buying wheat from farmers in the Alsace region of France. Cargill was founded in 1865 when William Wallace Cargill opened a single grain warehouse next to a railroad line in Iowa, a wooden building holding a fraction of what one of the company's modern terminals can move in a single afternoon. Archer-Daniels-Midland took its current shape in the early 1900s, built around the processing of oilseeds in the American Midwest. None of them set out to control the world's food supply. They set out to solve a much smaller problem. Farmers grow more grain than they can sell directly, and someone has to buy it, store it, and move it to where people actually need it. Over more than a century, each company grew by repeating the same pattern: buying grain elevators, building rail lines and port terminals, financing farmers who needed cash before harvest, and expanding into new countries as global trade opened up. 4 separate companies on 4 separate continents slowly converged on the same result. That scale isn't permanent, and it isn't uncontested. A state-owned Chinese trading company, COFCO International, has expanded aggressively over the past decade and is now large enough that some analysts count it alongside the original 4. The old order is being tested, not frozen in place, but for now it still holds. But scale, ownership, and history only explain part of the story. They tell you how big these companies are and who legally owns them. They don't yet explain the part that matters most: how control over grain elevators and rail lines turned into something that behaves in practice like control over price itself. To understand that, you have to follow the money through every stage of the journey, from the seed in a farmer's hand to the number on a grocery store receipt, and every silo, ship, and contract in between.
Here is the part most people never think about. These 4 companies rarely make their money by simply buying low and selling high the way a corner store does. Their real advantage comes from something much harder to copy. They are present at almost every single stage of the journey grain takes, at the same time, all over the world. Start at the very beginning, before a single seed goes into the ground. In many countries, farmers don't have enough cash on hand to buy seed, fertilizer, and fuel for the season. So one of these 4 companies lends it to them, often in exchange for the right to buy the harvest later. That single relationship already gives the company 2 things most competitors don't have: an early ground-level view of how much grain is likely to be planted, and a guaranteed buyer position before the crop even exists. When harvest comes, the same company is frequently the one buying the grain, weighing it, grading it, and storing it, usually in an elevator or silo it already owns. From there, it moves the grain using rail lines, river barges, or ocean freighters that again are frequently owned or contracted by the same handful of companies. In 2025, Bunge completed an $8.2 billion merger with Viterra, a major grain handler that had previously belonged to the commodities giant Glencore. That single deal folded even more silos, ports, and rail capacity into just one of the 4 companies, at a moment when regulators in multiple countries were already asking whether the industry was becoming too concentrated. When the grain reaches a processing facility, it's often crushed into oil, milled into flour, or turned into animal feed, another stage these companies frequently control directly. Only after all of that does the product finally reach a food manufacturer who turns it into the bread, cereal, or cooking oil you actually buy. Financing, storage, transport, processing, and sale, one continuous chain, and often one set of hands controlling several links of it at once. Picture an ordinary business that only owns one part of that chain, say a trucking company that hauls grain from farm to port. It only earns money when someone hires it to move something, and it has no idea what's happening at the farm or at the port beyond its own delivery. Now picture a company that is the lender to the farmer, the owner of the silo, the operator of the truck, the owner of the port terminal, and the buyer at the other end. It isn't earning a fee at just one point in that journey. It's positioned to capture value at almost every point along the way, and it sees the entire picture no single link in the chain could ever see on its own. But physical control over grain is only half of how the money actually moves. The other half happens somewhere most people never see: the futures markets, where traders buy and sell contracts betting on what a crop will be worth months before it's even harvested. This is where being everywhere at once becomes a genuine financial advantage. A company that owns storage in Ukraine, shipping contracts out of Brazil, processing plants in the United States, and buyers under contract in Asia has something almost no outside investor has: a real-time physical view of supply and demand across the entire planet. It knows when a drought is hitting one region before that shows up in a headline. It knows when a country's warehouses are unusually full or unusually empty. That information doesn't need to be stolen or manipulated to be valuable. Simply having it first and having it from every angle simultaneously is enough to trade the futures market more accurately than almost anyone at the table. If this is the kind of financial mechanism you genuinely find interesting, this is exactly the kind of story Capital and Consequence exists to tell, so consider subscribing while we keep going. This combination, physical control plus informational advantage, means these companies don't actually need prices to move in any particular direction to make money. Rising prices can mean bigger margins on grain already sitting in their silos. Falling prices can mean cheaper grain to buy and store for later. Even chaos and uncertainty can be profitable, because volatile markets are exactly where a trader with better information and more flexible positioning tends to win. The mechanism isn't a secret conspiracy. It's simpler and in some ways more unsettling than that. Whoever sees the entire chain gets to profit from every stage of it, no matter which way the market moves. Here's a simplified version of how that plays out in practice. A trading company holding a large stock of wheat can sell futures contracts today, locking in today's price for grain it will deliver later. If the price then falls, it still gets the higher price it locked in. If the price rises instead, it can adjust its physical sales to capture the upside too. Either way, it's protected, a position most small farmers and most ordinary buyers simply don't have the scale, the credit, or the market access to take for themselves. Which means the next number worth asking isn't how the mechanism works, it's what it actually paid out and to whom the last time the world's food supply was truly tested.
2022 is the clearest window into who actually wins under this system, because it's the year the mechanism was tested by real crisis. Russia's invasion of Ukraine knocked two of the world's largest wheat and corn exporters out of normal trading almost overnight. Global food prices spiked to some of the highest levels on record, and according to the United Nations World Food Program, more than 300 million people moved into acute food insecurity that year. Now look at what happened inside the four companies during that same period. Cargill closed its fiscal year with roughly $165 billion in revenue, a jump of about 23% and the highest earnings in the company's history. Archer-Daniels-Midland reported a record net income of about $4.34 billion, up roughly 60% from the year before. Bunge sales climbed by about 17%. Louis Dreyfus, which doesn't report publicly in the same detail, posted a profit increase of more than 80% the year the crisis began. None of these numbers on their own prove wrongdoing. Grain traders are supposed to make more money when volatility increases. That's a known feature of how commodity markets work, not necessarily evidence of manipulation. But the scale and the timing are hard to ignore. A small group of companies sitting at nearly every stage of the food supply chain posted their best results in decades in the exact year the World Food Program was warning of the worst hunger crisis in a generation. In 2023, the United Nations Conference on Trade and Development published a report examining this pattern directly, arguing that concentrated market power in food commodities allowed a small number of large firms to capture outsized profits during the crisis, even as the underlying reasons for higher prices were genuinely tied to war, drought, and supply disruption. It's also worth looking at what happened after the crisis eased, because it reveals something just as telling as the boom itself. By 2024 and 2025, global food prices had cooled, and profits at all four companies came back to earth. Cargill's net income fell to its lowest level in nearly a decade, and both Cargill and Archer-Daniels-Midland announced job cuts. But notice what didn't happen. None of the four companies posted anything close to a catastrophic loss, and none of them lost their grip on the infrastructure they control. The downside for them looks like a smaller profit. For a farmer without storage, financing, or futures desk of their own, a bad year can look like losing the farm entirely. So who specifically captured that windfall? Not necessarily who you'd picture first.
The most visible face of a company like this is usually its chief executive, the person who appears in interviews and earnings calls. But at Cargill and at Louis Dreyfus, the bigger winners are quieter than that. They're the founding families. Roughly 88% of Cargill still belongs to descendants of the Cargill and Macmillan families, a group of around 25 people spread across generations. When Cargill posts a record profit, most of that value doesn't go to employees or even primarily to executives. It flows through ownership directly to that family's collective wealth. Louis Dreyfus works the same way, with profit ultimately benefiting descendants of the family that opened its first trading desk in France in 1851. These are in effect private dynasties whose fortunes rise and fall with the price of wheat, corn, and soybeans, largely outside public view, because neither company is required to disclose the kind of detail a publicly traded corporation must. At Archer-Daniels-Midland and Bunge, where shares trade publicly, the winners are more diffuse: institutional investors, pension funds, and shareholders who benefit when the stock price and dividends rise alongside profit. But even there, the position each company holds, control over storage, transport, and processing infrastructure that's extremely expensive and slow for anyone else to replicate, acts as a kind of moat. Competitors can't simply decide to build hundreds of grain elevators and a global shipping network overnight. That barrier to entry is itself a form of protected advantage, one that keeps the same four companies winning year after year, almost regardless of who happens to be running them at any given time. What ties all of this together is a pattern worth sitting with. The biggest winners in this system aren't necessarily the people making headlines. They're the ones holding ownership positions built up over generations, protected by infrastructure that took over a century to assemble, and largely invisible to the people whose grocery bills fund it.
If ownership and infrastructure explain who wins, the other side of the ledger is just as important and considerably less comfortable to look at. Start with the farmers who sit at the very beginning of the chain these companies control. Many of them depend on pre-harvest financing from one of the four companies just to afford seed and fertilizer for the season. That financing comes with a condition. The farmer typically agrees in advance to sell the harvest to the same company that lent the money, often at a price set closer to planting time than to harvest time. If prices rise sharply between planting and harvest, the farmer may have already locked in a lower price and missed the upside. If prices fall, the farmer still owes the loan. Either way, the party with less capital, less storage, and less access to futures markets is the one absorbing more of the risk. For a smaller farm, that imbalance compounds year after year. A large trading company can absorb a bad harvest in one country by drawing on profits from a good harvest somewhere else in the world. That's part of what global scale is for. An individual farmer usually has no such cushion. One failed season, one broken piece of equipment, or one poorly timed sale can be the difference between staying in business and losing the farm entirely, regardless of how the broader market performed that year. On the other end of the chain are the consumers, and this is where the human cost becomes hardest to separate from the numbers. When wheat, corn, and cooking oil prices spike, the increase doesn't land evenly around the world. Wealthier households in wealthier countries absorb it as a slightly larger grocery bill. Households already spending most of their income on food, which describes a large share of people in lower-income countries, can be pushed from food insecurity into outright hunger by the same price movement. According to the World Food Program, the number of people facing acute food insecurity climbed past 300 million during the 2022 crisis, a period that overlapped almost exactly with the record profits described earlier in this documentary. That overlap doesn't prove any single company caused any single family's hunger, but it does mean the same market conditions that strained household budgets around the world were, for a small number of firms sitting at the center of the system, remarkably good for business. There are also more direct, documented cases where the cost landed on specific institutions rather than on the public at large. Between 2011 and 2023,
Argentina's tax authority pursued a case against several of the major grain traders, including Cargill, alleging that the companies had used a practice called transfer mispricing, routing sales through subsidiaries in low-tax jurisdictions to reduce the tax owed on grain exported from Argentina. In 2023, an Argentine tax tribunal ruled against Cargill in one such case. When a company shifts profit away from the country where the physical grain was actually grown and shipped, the government of that country collects less revenue than it otherwise would, money that would have funded public services in a country that grew the crop, rather than one that merely processed the paperwork. There's also the case of Archer-Daniels-Midland's own investors. In January of 2024, the company disclosed an accounting investigation tied to its nutrition division, and by January of 2026 had agreed to pay $40 million to the Securities and Exchange Commission to resolve fraud and disclosure charges, with a former chief financial officer still facing separate legal proceedings. In a case like this, the people who pay aren't hungry households on the other side of the world. They're shareholders who bought stock based on numbers that regulators say didn't tell the full story, and employees whose jobs were affected when the company subsequently moved to cut costs. There's also a cost that doesn't show up on any balance sheet at all. Environmental researchers and organizations, including Greenpeace, have repeatedly linked the soy and grain trade in South America to deforestation pressure in the Amazon and the Cerrado, arguing that demand from major international trading companies, including several of the four discussed here, has historically helped drive land clearing for new farmland. The industry has responded with commitments like the Amazon Soy Moratorium, an agreement among major traders not to buy soy grown on recently deforested land. How completely that commitment has been honored across every supplier remains a genuinely disputed question between the companies and their critics. What's not in dispute is who bears the environmental cost when it does happen. Local communities and ecosystems thousands of miles from the boardrooms where sourcing decisions are actually made. Layer all of this together, farmers absorbing price risk, consumers absorbing hunger risk, governments losing tax revenue, investors absorbing the fallout of accounting failures, and distant communities absorbing environmental cost, and a pattern emerges. The people and institutions paying the price are rarely the same people making the decisions inside the four boardrooms at the center of the system. The risk flows outward. The advantage tends to stay close to home.
Everything so far has been about profit. Who earns it, who funds it, and who's left holding the risk. But profit is only the first layer of what's actually happening here. The deeper story is about what that profit and that infrastructure eventually buy. Influence over decisions that have nothing to do with grain prices at all. Picture a wheat shipment sitting in a port in Ukraine during the darkest months of the war. Millions of dollars of grain going nowhere because no insurer will cover a ship sailing through a war zone, and no captain will risk the crossing without one. That grain doesn't move because a general orders it to move or because a president signs a treaty. It moves the moment a private company decides the insurance, the shipping contract, and the port access all line up. In that instant, a corporate decision matters as much to global food supply as anything happening in a war room. Start with a basic fact of geopolitics that rarely gets discussed openly. Countries that can't feed themselves are vulnerable in ways that go far beyond economics. When the 2022 crisis hit, at least 20 countries responded with restricting or banning exports of wheat, rice, and other staples, trying to protect their own populations first. That single fact reveals something important. Food security is treated by governments as seriously as energy security or military security, because a hungry population is an unstable one, and instability at home has a way of becoming a government's most urgent problem.
and the physical infrastructure that determines whether food actually moves across a border in a crisis, the storage, the shipping, the port access, belongs in large part to these 4 private companies. That gives them a form of leverage governments can't simply legislate away. When the war in Ukraine threatened to cut off one of the world's largest wheat and corn exporters, the resulting Black Sea Grain Initiative, brokered by the United Nations and Turkey, depended on cooperation not just between Russia and Ukraine, but on private shipping, insurance, and trading networks to actually move the grain once a corridor was agreed. Diplomats can negotiate a ceasefire on paper. Getting the grain from a silo in Ukraine to a port in Egypt still runs through infrastructure a handful of private companies control. That same leverage shows up in a quieter, less dramatic form during ordinary years, not just during wars. Because so much of the world's grain infrastructure runs through so few companies, governments trying to manage their own food security often have limited options besides negotiating directly with them. Securing storage capacity, shipping contracts, or purchase agreements from the same handful of firms that also happen to be trading against the market in the same commodities. It's not that these companies are issuing orders to governments, it's that governments trying to solve a food security problem frequently find there's no way around the companies that already control the physical choke points of the system. This influence also shows up in a more conventional form, direct political spending. According to Open Circuits, which tracks lobbying disclosures filed with the United States government, Cargill alone spent roughly $1.4 million lobbying federal lawmakers and agencies in 2025, on top of similar spending in prior years, covering issues from the Farm Bill to trade policy to transportation regulation. On its own, that figure is modest compared to the company's revenue, but it buys something money alone can't: a seat in the room when the rules that govern the entire industry are actually being written, long before any of it becomes a headline. Consolidation is making the underlying dynamic more pronounced, not less. When Bunge absorbed Viterra in 2025, regulators in the European Union, the United States, Canada, and China all had to review the deal before it could close, and the European Commission ultimately approved it only after requiring the combined company to sell off certain assets to preserve some competition. That regulatory scrutiny is a signal in itself. Even government bodies with the power to block mergers looked at the deal, recognized the risk of excessive concentration, and still allowed it to proceed, just in a slightly smaller form. The companies didn't need to defeat the regulators, they only needed enough leverage to negotiate the terms. This is what it looks like when capital quietly becomes power. Not a single dramatic moment where a company issues an ultimatum to a head of state, but a slow accumulation of physical control over silos, ships, ports, and financing, combined with a steady, ordinary presence in the rooms where policy gets written. Governments, farmers, and international institutions all eventually find themselves needing something only a handful of private companies can reliably provide. The 4 companies don't have to ask for a seat at the table. By controlling the infrastructure the table depends on, they're already sitting in it.
If you stayed with us this far, consider subscribing to Capital and Consequence and join us for more long-form documentaries about money, power, and the consequences hiding behind the headlines. So where does this go from here? No one can say with certainty how the balance of power inside global food trade will look a decade from now, but the available evidence points toward a few plausible directions worth taking seriously. The first is more consolidation, not less. The Bunge-Viterra merger in 2025 was the clearest recent example, but it likely won't be the last. Every time 2 large players merge, the remaining companies face pressure to grow or partner just to keep pace, and regulators have so far shown they're willing to approve these deals as long as some divestitures are attached.
Under this trajectory, the 4 in ABCD could plausibly become 3 or reshuffle into new alliances without the underlying concentration of power actually decreasing. The second direction cuts the other way, erosion of that dominance, not from regulation but from competition. COFCO International, backed by the Chinese state, has already grown large enough that some analysts count it as a 5th major player alongside the original 4. If state-backed trading companies from China and potentially other major agricultural economies continue expanding their own storage, shipping, and processing capacity, the tight grip these 4 companies have held for decades could gradually loosen, not because anyone broke it up, but because new competitors built their own version of the same infrastructure. A third possibility is regulatory, though the evidence so far suggests it's the least likely of the group. Antitrust regulators in the European Union, the United States, and elsewhere have shown they're watching this industry closely. The divestitures required before the Bunge-Viterra merger could close are proof of that. But watching closely and breaking up a century-old system of vertically integrated infrastructure are two different things. Under current regulatory trends, a formal breakup of any of the 4 companies looks unlikely in the near term. A slower path, new conditions attached to future mergers, stricter disclosure rules, or targeted enforcement actions like the one against Archer-Daniels-Midland is the more probable version of regulation actually reshaping the industry. A third factor sits above both of these scenarios and could make either of them more urgent: climate change. Scientists studying agricultural regions have warned that shifting rainfall patterns and more frequent droughts could make harvests less predictable in some of the world's most important grain-producing regions over the coming decades. Picture a wheat belt that used to deliver a reliable harvest 9 years out of 10, now delivering one only 6 or 7, and every missed harvest making the companies that already own the world's spare storage and shipping capacity that much more essential and that much more powerful. If that happens, the value of controlling storage, transport, and market information, the exact assets these 4 companies specialize in, could increase even further, since predictable infrastructure becomes more valuable precisely when the underlying supply becomes less predictable. There's also a scenario that would work against these companies, a genuine transparency shift. Part of their advantage has always come from seeing the whole chain when almost no one else could. But satellite crop monitoring technology, much of it now commercially available, is giving governments, journalists, and even smaller trading firms a clearer view of harvests and shipping movements than they've ever had before. If that trend continues, one open question is whether the informational edge that built this entire system slowly narrows, not because anyone forced these companies to share what they know, but because the rest of the world simply gets better at watching the same things they've been watching all along. One more trend deserves attention because it could push in the opposite direction: food nationalism. The export restrictions imposed by roughly 20 countries during the 2022 crisis were framed as emergency measures, but similar restrictions have reappeared during smaller regional shortages since. If more governments treat food the way some already treat energy or semiconductors, as a strategic asset too important to leave entirely to open markets, global trade could fragment into more regional, state-influenced blocs over time. Under that scenario, the 4 companies wouldn't necessarily lose influence. They might instead find themselves negotiating with a larger number of more assertive governments, rather than the relatively open global market they've operated in for most of the last half-century. Which of these paths wins out likely depends less on any single decision and more on how quickly climate pressure, technology, and geopolitical rivalry move relative to each other. What does seem clear based on the pattern of the last decade is that whoever controls the physical choke points of the world's food supply when the next crisis hits will be positioned to benefit from it, the same way the 4 companies at the center of this story were in 2022. At the start of this documentary, we asked how a handful of companies almost nobody can name ended up controlling something as basic as food, and what happens when the people who control the supply also control the price. By now, the answer isn't a conspiracy. It's simpler and in some ways more uncomfortable than that. 4 companies, Archer-Daniels-Midland, Bunge, Cargill, and Louis Dreyfus, spent more than a century quietly assembling every link in the chain between a farmer's field and a family's dinner table. They finance the planting, they own the silos, they control the ships, the ports, and much of the processing in between. That position doesn't require them to fix a single price by hand. It only requires them to see the entire system at once, while almost everyone else, farmers, governments, and consumers alike, sees only their own small piece of it. That advantage held up under the worst possible test. In 2022, as war disrupted 2 of the world's largest grain exporters and pushed more than 300 million people toward hunger, these 4 companies posted some of the best financial results in their history, not because they orchestrated the crisis, but because a system built to profit from volatility will do exactly that, whether the volatility comes from war, weather, or simple bad luck. And whoever built that system first gets to benefit from it every single time. The winners in this story are rarely the loudest names in the room. They're founding families who have held their positions for 150 years, shareholders who never have to touch a single grain of wheat, and infrastructure so expensive to replicate that competition alone can't easily break it apart. The people who pay are almost always somewhere else. A farmer locked into a loan, a government losing tax revenue it never sees again, a family paying more for bread it didn't expect to cost more this month. And the consequence goes further than any single balance sheet. When the war in Ukraine threatened global grain supplies, it wasn't only presidents and diplomats negotiating a way through the crisis. It was private shipping networks, insurance contracts, and storage capacity controlled by these same 4 companies that determined whether a ceasefire on paper actually became grain moving through a port. When regulators in multiple countries reviewed the Bunge-Viterra merger, they weren't just approving a business transaction. They were formally acknowledging how much of the world's food infrastructure now sits in the hands of a shrinking number of private companies. Money in this story didn't just buy profit, it bought a permanent seat at tables that decide how nations manage one of their most basic needs. None of that makes these 4 companies villains in any simple sense. They didn't invent hunger, and they didn't start the war that triggered the worst of it. What they did was build, over more than a century, a position so central to the world's food supply that they were guaranteed to come out ahead almost no matter what happened next. A position most of us never noticed because it was never built to be noticed. Every system like this one runs on the same quiet arithmetic. Visibility is expensive to build and easy to avoid. A silo, a shipping line, a financing relationship with a farmer half a world away. None of it makes headlines the way a war or an election does, and that's precisely what makes it durable. 4 companies didn't need to control governments to gain this kind of power. They only needed to make themselves the one thing every government, every farmer, and every food company on Earth eventually has to go through. That, in the end, is maybe the most important lesson this story has to offer. The deepest forms of power rarely announce themselves. They just quietly make sure that whatever happens, they're standing exactly where the money has to pass through. If this is the kind of story that changes how you see the world around you, that's exactly what Capital and Consequence is here for. Subscribe if you'd like more documentaries like this one, and if you found it useful, a like genuinely helps more people find it. Share it with someone who cares about money, power, or how the world really works behind the headlines. And if you have a moment, leave a comment and let us know, what financial story or global power struggle should we investigate next? For viewers who want the full research dossier behind this documentary, the Capital and Consequence dossier is available in the description. Until the next documentary.
Capital and consequence. Follow the money. Understand the consequences.